Thank you, Tim, for that. And without further ado, let me try and figure out how this thing works that I've just been told by BVCA. So I work for a technology company. I ought not to be low tech. So why don't I have the panel introduce themselves, and we'll get started. Thank you.
Hi, I'm Alex Macpherson. I'm chairman of Octopus Ventures. We are a fund that invests in early stage technology and have a capability to continue to back those businesses all the way through as they develop. Talking about exit readiness, exits that we've had are businesses like Zoopla, Tails most recently, Magic Pony, which was very much a tech business, and a business called SwiftKey.
Good. Fernando Chueca, I'm with the Carlyle Group. Carlyle Group is a large private equity organization. In fact, we used to own SS&C. We took private SS&C and then floated it back. I will provide a slightly different perspective because we tend to look at businesses that are at a later stage. Many of them still founder-owned, and where we like to partner with founders to provide them either a partial exit or a full exit of their investment, but to basically maintain the independence of the business and take the business forward.
Joe Knowles, Smedvig Capital. We're primarily a venture capital investor trying to lead Series A and B rounds into UK-based tech and tech-enabled companies, so more from Alex's world. But we also have separately a fund-of-fund operation where we invest in some major private equity firms. So we have a good view on the exit landscape from that as well.
Osman, Qureshi. We're focused on investing in energy, in upstream, but it involves creating platform companies, which then grow by acquiring assets. And until about a year ago, I was with an infrastructure fund where we have, over the last 12 months, exited half of the fund. And so that's...
Thank you. So look, I mean, as we were discussing earlier, in a sense, the best way to paraphrase our couple of phone calls is, exit readiness is really a journey. And I guess each of you bring a different perspective in terms of what that journey is all about for each of your firms. And the first question is that as you buy a company, do you have a sense of where the exit would be? So do you have a sense of what the destination would be, and do you chart your journey accordingly? Or do you sort of build upon it and sort of arrive at a certain critical mass in the company that you've acquired and then decide how you're going to exit? So I guess the question is, what are the critical steps that you take in this journey in terms of exit readiness? And shall we start with you, Alex?
So I think, the first thing as a venture investor, we don't buy the company, we don't own the company. We partner with the entrepreneur in order to help them have the facilities to develop the business. And it depends on the stage of the business that we're investing in. So a very early stage business at sort of C stage, you may not have that clear universe. A later stage business at the Series B stage, absolutely, you want to think, okay, where can this business go to? Who are the likely acquirers? How will you be exiting from this business? And that's from IPO through to trade sale. Could be a sale to a private equity purchaser. So, you start to think about those sort of aspects.
Yeah, I guess from our perspective, we tend to buy businesses in backing management, and as I said before, sometimes alongside a founder, but we tend to buy businesses that have already sorted out most of the basics. They have a clear business model, they have a clear, more or less clear go-to-market. Effectively, most of the scaffolding is in place, and what we're doing is backing a plan, and that plan would see hopefully value being created and a transformation of the business. So exit readiness becomes, it starts the moment that we buy the plan, and everything we do is to try to determine whether we are hitting that plan, whether we need to change the strategy, and also being ready to demonstrate with actual data, with numbers, when we come to an exit, that everything that we did was deliberate, that we have a vision, that we have a strategy, and that we can prove all the steps we've taken towards that strategy, and then ideally you can extrapolate beyond that. But everything revolves around, what is the 3 to 5 year plan that will see a transformation of the business, and that's effectively, what exit readiness is basically all about, I guess.
Well, for us, in quite stark contrast, actually, we spend relatively little time early on up front thinking about exit, actually. I mean, we'll discuss it in the early investment phase, what the potential routes might be, but actually, at the stage we're coming in, a bit like what Alex was saying, really the focus is on building a big profitable business and focusing entirely on that and knowing that eventually if you achieve that, the exit will come. So actually we spend relatively little time worrying about it. One thing that is important to get right up front though is to understand what a good exit looks like for both the management team and the investor, to make sure that we're both aligned and to modulate that throughout the life of the deal as you do eventually progress towards an exit.
Yeah, so like Kamran said, exit is a journey which starts really when you invest in the company and then manage it through your ownership, and ultimately, while you're managing during your ownership, you really want to make sure that when you exit, people pay not just for your cash flow, meaning your historic cash flow, but also the growth potential that the new buyer sees. So you really want to always have a business model and a plan where revenue and EBITDA continue to climb, and the management goes from one success to another, and because you only have usually 5, maximum 10 years if you invest early in a fund to own a company, and so the exit is all about the years that you own the company to make sure it's growing, and so that you have a bonanza exit where people pay for that potential and growth.
To pick up on something that Joe said is about alignment,
right?
Because an exit it may be for a financial investor, it is an exit. It may be for angel investors, it can be an exit. But it may not be an exit for the management team. It may only be a partial exit for the main investors. If you're selling to, or if you're IPOing, there'll only be some money taken off the table. If you're selling to a financial purchaser, there's a likelihood there's going to be a certain amount of roll. I don't know, the levels of roll that you've seen, Fernando, with regards to founders.
We've seen founders that have rolled over 90 to 100% of their stake. Those are the situations we like the most. We don't mind cashing out seed, angels, early investors. Cashing out management, it's a necessity of our business model. But we wouldn't exist if we were not cashing out some founders from time to time. But when a founder comes and says, "I believe in the story so much that I don't want to take any cash out," that's when our investment committee tends to be happier, right? I'm not saying that you should not take some cash out, but that clearly makes our life easier.
The important point is sort of alignment of interests, especially with management teams early in the game, especially for venture players like yourselves. I think we should dig into that a little bit more, especially because we have a number of portfolio companies present here this afternoon. So would you give us some anecdotes or examples of where alignments of interest with management teams have worked, and what are some of the critical success factors in those? How have you facilitated that? Shall we start with you, since you?
Yeah, I was going to say, for me, I think it's just being realistic about the quantum of exit and therefore the type of buy you're going for. I mean, whenever we see Series A and B pitch decks, everyone's talking about the billion-dollar market, and because they've sort of been trained that that's what you have to do. But the reality is, 90% of exits are 200 million or less, and as the business progresses, it becomes clear what kind of route you're on, both of which can be great results for everyone. So I think being honest and realistic about that is a really important step to take.
Yeah, I fully agree with your point, and there are two things that can become toxic upon an exit. One is very complex capital structures. I mean, we've seen businesses that have A, B, C, D, E, F, G, kind of, all of them with liquidation preferences, and effectively the management equity only breaks at a valuation that you know is not going to happen. So that's a big issue. And the second one, which is actually created partly because of that, is because sometimes people prefer, investors or existing shareholders, they prefer a toxic instrument in exchange for high valuation because they can go out and say, well, I raised at a valuation of $1 billion. Now, I don't go and tell everybody that that valuation of $1 billion, the quid pro quo is that the 100 million I've taken has a 3-time liquidation preference, a full ratchet anti-dilution protection, whatever. So sometimes, I used to do venture early on in the late 90s, and I've seen that when the bubble burst in in 2000, some of those structures were impossible also almost to untangle. So having a clear capital structure goes a long way on aligning interest.
I think the biggest thing for us is making sure you understand what the management team, the people who are going to be taking that business forward, what they really want, what their aspirations are. Because there's lots of ways that you can help fulfill that. And an exit to a trade purchaser may be only one of them. But what sort of trade purchaser? Do they want to actually be working for that business going forward? I really want to work at Google, but I don't want to work at Microsoft. And I'm never going to accept something at Microsoft, and that's a critical person in the team. You're going to have problem in diligence.
But isn't he more interested in getting rich rather than where he chooses to work?
That then boils down to how good is the business, and he knows he's going to get rich because you can continue to build the business going forward, and that's turning around and saying, okay, people, what's rich? How rich do you want to be? There are entrepreneurs now in the UK, which is fantastic, where they're saying, I won't take 100 million, I won't take 200 million. I'm going to build a multi-billion pound business. And that's the sort of level of aspirations. It doesn't mean that they won't take money out along the way and de-risk the proposition for themselves. But that's what the ambition is. And at a certain point of wealth, the ambition is to go and build something really significant, and it is absolutely industry defining. Danny Eck didn't take a lot of money out of Spotify.
Yeah, no, it's a good point. You have to have complete alignment. The whole private equity model works on, if there's one principle of it, is the alignment of interest between the investor and the management team, and you have to have complete alignment. I've seen cases where management teams have sabotaged an exit because they weren't happy in the direction it was going. So that's really, really key.
Yep.
I'm not going to ask how they went about sabotaging it because there's too much water for the audience.
I probably don't want to talk about it anymore.
So in terms of, a part of the whole exit planning, sort of having been on the other side of the fence many, many years ago, I do know that exits and M&A deals in general tend to be fairly disruptive. So I would imagine that as you are planning for exiting your partner companies or portfolio companies, you're also keeping an eye out for the disruption that this might cause and having the right processes in place to manage that disruption. Would you care to comment on how you go about minimizing disruption? Yeah, start with you.
Yeah, it's little things like, if you're going to go through an exit process, most of our entrepreneurs do not understand how disruptive that is for the business.
Right.
So making sure you've got the right team in place. And, acquirers want to see the CEO. They want to see the senior team. So if you think if you're going to be going to either strategic or to financial, your financials need to be in a really good state. So, getting a CFO in who is used to this process, who can help run the process for you. We're a big fan of using advisors. Take a lot of the load off members of the team. But actually, it's a huge distraction for the business. And be prepared for that. Because one thing's for absolutely certain, if you're selling your business and your numbers start to trend the wrong way, you're going to start to have problems.
Flow of information, I think that's an important point, right?
Yeah, and that's kind of critical because you need enough people within the business to know that the business is for sale in order to be efficient and prepare all the materials. But at the flip side is that you don't want everybody in the organization to start, worrying or becoming uneasy about the prospect of a sale. So, ideally you don't want more than, I think, a number of 5, 7 people to know, but you need at least 5 people to know, because if it's only the CEO, it's impossible for him to drive an exit process. So I agree with that. And the second, I fully agree with what Alex said, leverage advisors to the extent that you can. So for instance, doing some sort of vendor due diligence, it can be very helpful to make sure that then you have all the information available, put together a data room ahead of the process, so you are not dealing with basic requests during the process, only with exceptional ones. So those are the kind of things that I would encourage.
Yeah, I think one of the key rules of an exit process is that the business has to continue trading as normal throughout that process. The worst possible thing is for you to start missing plan or to something to not look normal. So even though it's behind the scenes, it's probably absolute chaos and extremely testing time. The most important thing is to keep the business on track during that time. And I think, again, the stage we're coming in at, when we do exit, it might actually be for the management team the first exit they've had, and it is quite a harrowing experience. If you thought fundraising was bad, try doing an exit where it's even more thorough processes involved. So I think making sure that anyone that is going to be involved is prepared for that and is expecting that level of interrogation is really important, and to be upfront about that early doors.
Yeah, exactly. I mean, it's I would keep only the 3 or 4 or 5 people informed. They obviously need to know to make sure they tie up any loose ends, any outstanding lawsuits, whatever, and so that the company is clean and ready to exit.
Talking about sort of company is clean, in my former life, I used to acquire businesses for banks, and in addition to the core value proposition of that acquisition, for a bank at that time, the internal governance and controls of the entity, the cleanliness of the entity from an AML KYC perspective used to be incredibly important. How do you think this whole point around controls and governance has evolved in the last 3, 4, 5 years, and have you seen more focus on that, especially from the trade buyers, as you sort of look to sell the companies that you own? Shall we start with you, perhaps?
Yeah, I'll give you 2 perspectives. As a buyer, massive increase. Our company is publicly traded, and it's also a large player in the private equity space. So we are the target of regulators. Anything that we don't do correctly, we're put to shame. So yes, as part of our due diligence process, from 5 years ago, we have a standard set of processes dealing with anti-money laundering, with anti-bribery and corruption, with all sets of regulations, because many of those are very far-reaching. They cut across jurisdictions. U.S. sanctions, for instance, cut across jurisdictions and can have a lot of implications. So for us as a buyer, very important. But also we believe that it's going to be very important as the owner of a company that then will be acquired later on by a trade buyer potentially, because all those trade buyers are also heavily regulated, and the last thing they want is to acquire something that later on becomes toxic or creates some regulatory compliance problems. So definitely a very, very important topic.
And Osman, your perspective, you've got a big emerging markets background and experience, especially in the Middle East. Would you care to comment? There's a lot been going on recently in the region that we are both very familiar with. How important are these things becoming for buyers of companies, and therefore how important is it to have that on the exit readiness agenda?
Well, I think the part of the Middle East that I operated in, UAE, it has a good reputation. It's clean, and we never had. It's seen as a AA country, and never really had the emerging markets issues. But about 10 years ago, or 12 years ago, when I was investing in India, it was it's a major issue, because typical emerging markets issues about transparency and governance and all of that, which is even in publicly traded Indian companies, governance barely exists. But here, recently, I think the main change that we've seen as an infrastructure, energy investor, environment, health, and safety have always been primary for us, for me. But the new thing is now also behavior, personal behavior of executives, right? I mean, if as you know, some recent executives who've fallen because of bad behavior. So that is a part of due diligence that we maybe wouldn't have done before, but now we want to make sure that people have always behaved in a gentlemanly or ladylike fashion.
Yeah. I will echo that. I would say that we also have always an audit committee, a remuneration committee, and increasingly in all the boards we look at, risk register and compliance with other principles, right? Fairness of treatment with individuals, employees and customers and suppliers. So all those things are definitely important. And also they give a good impression. They give the impression of this being a well-managed, serious business, which at the end of the day, that's what you want to do.
So I think it also goes to because you'd add to that now ESG programs and so forth. What are we doing there? But it goes beyond that. So I say actually take a bit of a step back and look at your cap table. If you've got 50 people on the cap table, and most acquirers these days will require 100% consent. Certainly the US acquirers will require 100% consent. So how are you going to go about getting that? So start to think about those things at an early point because you're going to need powers of attorneys and things do shift later on in the transaction.
I think similar point to the cap table point, but taking that view on the board composition as well.
Yeah. On
the board composition.
Yeah, yeah. Let's talk about that a little bit. Let's talk a minute about board composition and how you think about it and how sort of it plays into this whole exit readiness ecosystem.
I think for us, early doors, the boards are pretty simple. A few members of the management team and the investors and probably an external chairman. But in the run-up to exit, thinking about what board members you can bring in to help with that governance piece is very important. So, for example, with a fintech business, you might bring someone with a regulatory background onto the board to help with that aspect of the business. So I think it's very sector-specific in my experience. But it's certainly a big part of the exit readiness process is thinking about people you can bring onto that board to add that external governance view.
And certainly if you're going to an IPO, then you've got a whole set of other issues to deal with, and you need an independent board. And as investors, we're not independent.
Well, a question has just come in that I should ask, and that is it a help or a hindrance to take investment from a strategic partner who could possibly be an acquirer in the future?
I think it's a hindrance. I think it's alignment of interests, between investor and the management team is really, really important, and that's much harder to do with the strategic investor, simply because especially if private equity is involved. So while private equity may be interested in maximizing returns, management team may be interested in building, a company for itself, and the strategic investor may simply be eyeing you as, a new subsidiary or a division, and so I've been involved in situations that it's usually not a happy one.
Yeah. I would say that sometimes it's justified to take an investment from a strategic partner that eventually may become an acquirer. But if you're going to do that, I would recommend that at the minimum you force them to waive their preemption right, or at least to have very clear rules on when can they make an offer or not. If they don't make an offer, you have a full drag along on them, and you can exclude them from the board so they cannot see the other bids and other things. So if they are still willing to invest and support the business with those, with those set of conditions, then probably it's worth it. But if they push back and they say, no, we want to have preemption right, and we will never give you a drag, and we want to be sitting on the table seeing all the offers, I'll look for other party.
I mean, it comes back down to alignment of interests.
Yeah.
And I think you've seen the rise in corporate venturing, across the world actually. And how are those people, the corporate venturing teams, how are they actually compensated? What's their purpose? Is it for financial gain, or is it to actually make bets on businesses that may be a hedge, for the corporate? So be mindful of who you're bringing around the table as investors. At times it works really, really well. You can have people who have got deep pockets with really good technological understanding of the market, can open boatloads of doors. So we're co-invested with a number of companies, from Google to Bosch, across the board. So
sure.
It can work well, but it depends on what is the relationship.
So look, I mean, I just want to move tack a little bit, and so we talked about exit readiness, and I just want us to, before we conclude, talk about different exit routes, and how that process sort of plays in your minds, and how routes have evolved. And Osman, perhaps you have just had a recent exit, and my team has the pleasure of doing the distributions for it, so we know the details. So why don't you walk us through?
Well, the choice is, selling to another PE investor or a private investor, selling to strategic, or doing an IPO. And, despite what a PE firm may tell you, the preference is almost always to do a private sale to another company or another PE buyer or a private investor, or even a trade buyer, because it's easier. You get all the cash up front, and you're not forced to hold on to any shares that you would in an IPO, and it's clean, and then you don't have to worry about how the stock trades after it's gone public, etc. And but clearly, what we were talking about earlier, alignment of interest between management team. A management team may want to run a public company. I'm not sure why, but some do, and so they. So you have to take that into account, and so it's a balance between those two forces for us.
The role of secondaries, have you seen that increase over time, Fernando?
Yeah, definitely.
Yeah.
Definitely. I mean, in private equity, there's a lot of money now. I would say that I don't have the data at the top of my head, but probably 40% of private equity exits are secondaries, or exits to another. Private equity. I mean, speaking about our own experience, out of the last 5 exits we've made, 3 have been to, so that would be 60%, for whatever it's worth, 6, have been to private equity. And management teams, if they believe in the story and they can take some cash out of the table, they tend to be, very amenable to private equity. With a trade buyer, most of the senior members of management team will see their job either being impaired or lost, or being synergized. So most people that believe in the business, that's why we think that private equity is a good alternative. And I agree with Osman that IPO tends to be very appealing at the beginning until people start to realize what are the implications of IPO, and then the reason why people still go IPO is because there is a valuation differential. And if the valuation differential is big enough, then obviously, it's worth it. But at equal valuations, I have not seen anybody that has not preferred to take cash.
Alex, any remarks? Especially on multi-track processes, perhaps.
Yeah, I mean, I disagree with Fernando. I think I use Zoopla as the example. I mean, there was a potential of running a dual track process, so of either going to IPO or selling to a financial. Went the IPO route. Actually, shareholders took 40% off the table at that particular point in time. At that time, the share price, £2.20 was the IPO. recently, the late star offer, £4.90, 3 years later. I'm looking definitely at Cordelia to try and tell me what it is. Actually, that's worked really, really well. So again, it comes down to what do you see as the opportunity and where do you want to play. I think the Spotify IPO in the States, really interesting. There was, it was kind of, right, we're just going to put it on the market. And we'll see what happens. I think the other thing that's really interesting is the rise of the secondary players pre-IPO. And think of the Fidelities, the BlackRocks, the Old Mutuals, the Bailey Giffords, who want to get into these businesses that they can see being multi-billion dollar pound companies.
Great, thank you.
Well, that's I agree, yeah.
I think the dual track point is quite interesting, actually. Even if it's front-loading strategics first to test that market before moving to trade, that's quite a common approach as well.
Thank you.
Well, Spotify example is good. I mean, sometimes a company is so huge, the only exit possible is an IPO.
Great. Well, I think we are out of time, but do we have time for one question, perhaps, if someone wishes to ask? All right. Thank you very much.